Has it not? But let's do one thing. Let's also talk about some numbers now. CSB Bank saw a sharp rise in the margins in Q3 and very strong deposit growth sequentially. The numbers were much higher than a lot of analyst estimates. So let's find out more. Pralay Mondal, the MD and CEO of CSB Bank, joins us now to discuss their Q3 performance. Mr. Mondal, thanks a lot for joining in. I want to first ask you about this sharp rise in margins. What led to that, and what do you think you can end the year with, and what's the exit margins that you're looking at for FY25 as well?
Good morning, Sonia, for having me on your show. Thank you for that. As I said in last quarter as well, that our margins, we will end the year somewhere above 5%, and we said that we will get the margins back on track. So this quarter we ended with around 5.11%, which is somewhere what we had targeted. And the reasons for this, of course, is three things. One is that we focused on businesses where we didn't have to kind of sacrifice margins. So we actually refused certain businesses which are below the levels where we wanted to do business, especially on the wholesale side. We also ensured that we remain focused on managing our cost of funds between the mixes of various funding strategies. And third is, of course, there are certain NPA provision which when it reverses, etc., it gives us some uptake. That's marginal. So overall, I think we had said what we had planned around 5%. We have retained that, and we should be able to end the year somewhere above 5% this year.
Okay, 5% in FY24, somewhere above that. You'll hold on to that for FY25 as well, you think?
FY25 we have to see, because there are two things which are happening. One is the repricing of the deposits are happening, and that will continue to happen for another 3 to 6 months, depending on the tenor of the portfolio. And on the other side, the EBLR linked and some of these other SME businesses, etc., once the interest rate starts coming down, if at all that happens, it has to be passed on. So given that, somewhere around second quarter of next year onwards, we have to see how this macro is playing out in terms of cost of funds and yields, because yields could have peaked out by then. So we have to look for that direction from RBI. If that is kind of managed, then we should be able to hold it to 5%.
All right. Hi, Mr. Mondal, and good morning and good to see you. When I recall at the end of the last quarter, you said, I'm going to get to 5%, and you've returned back to that. So I have to give you credit on that front. But, just looking at the breakup of your growth, and various segments didn't see too much growth. There's a scramble for deposits as well. So it appears the focus is on better yields. How much of your book was from the unsecured segment?
Good morning, Nigel. Yes, absolutely. We actually reduced our exposure on unsecured this quarter. And in a very focused way, we have significantly reduced, except for some of our internal customers on the unsecured book. So because we have taken the RBI direction very clearly, because obviously there are risk weights and all that, but we don't have a problem on the capital. But the direction is very clear that one needs to be cautious. So and given the small book we have, are entering that business, we have taken a very, very clear, cautious approach on unsecured. The other business where we have not grown that much is in the wholesale side. The reason being, as I said before, that we didn't want to do certain businesses which are coming at yields, which would have impacted our margins very badly. But in a range, see, for our bank, the range between the lowest yield and the highest yield is around 3%. Maximum comes to around 3%. If you take out some of the microfinance and the agri book, which is very small for us, mostly the 80%, 90% of the book is in the range of between 9 to 12%. So to that extent, we are not going to maximize the yields to get better NIMs, but we will be prudent in terms of management of the NIM vis-a-vis the yields and the risk we take. So that's the approach we have taken, and we'll always take that approach.
Okay, all right. And for the year, earlier you were guiding for 25 to around 30% growth. Do you stick by that? Are you likely to do better than that? And what about the next year?
So I think this year we have to try and see how the fourth quarter plays out. We are somewhere around 23% this quarter. We are growing faster. And that is a function of what we want to do in terms of liquidity management, because if you have seen those numbers, our CD ratio has come down to below 83% this quarter. It was above 87% last quarter. Our LCR on a period end basis is 123%, and on an average basis for the quarter is 113%. So we are focusing on prudent risk management on the liquidity side. Given the small size of our balance sheet, we have to be prudent. So if we see all of these liquidity management is doing well and we are able to retain our CD ratio and LCR where we want to be, then I think growth is not a problem. Growth will be a function of how the funding strategy plays out. And just because we have said that we will have a 25 to 30% growth, we will not stress ourselves to that extent when there is a funding challenge with 3 lakh crore negative liquidity in the system. So hopefully we'll be around 25, but if there is a liquidity challenge that continues, maybe we'll be somewhere around that.
All right. We'll leave it there. Shorter conversation today, but we'll have you back soon again. Thank you very much for joining us, Mr. Mondal, and running us through all of that. So that's CSB Bank in focus. Well,